Before capital conquered the world, it had to be free from its traditional constraints. This is the history of transnational capital. For centuries, European wealth was heavy. Wealth was mostly land. It moved with harvests. It depended on obligations written into custom and law. A lord's power came from controlling territory and the serfs bound to it. The village produced, the manor collected, the feudal lord protected and extracted. This was a world with both money and trade, but the main form of wealth, the land, was firmly fixed in place. Then Europe began to change around a simple discovery. A claim on wealth could travel farther than wealth itself. This will be the thread running through our story today. Capital grows more powerful each time it becomes more mobile. First, it moves through merchants, then through banks, then through shares, then through public debt and empires. Capitalism is built on controlling flows. The shift began in the cracks of feudal Europe. Towns and markets expanded. Trade fairs connected regions that rarely saw one another directly. A wool merchant in England, a cloth producer in Flanders, and a banker in Florence could become part of the same supply chain. None controlled the whole chain, but each learned that money could be made from movement. This mattered because feudalism was slow. It produced wealth, but it locked that wealth into hierarchy. Land was inherited. Labor was local. Authority was personal. A peasant could not simply move to a better market. A lord could not easily turn next year's rent into cash today. Merchants and bankers solved that problem. They made time and distance negotiable. Renaissance banking began with practical needs. Coins were heavy. Roads were unsafe. Currencies differed between cities. Long-distance trade required trust between strangers. The bill of exchange was the solution to this problem. A merchant could deposit money in one city and receive a promise payable in another. A banker could settle the account through partners and ledgers. The transaction looked like payment, but it also contained credit. Exchange rates and timing created profit. Money could earn money without moving physical metal. This was a quiet revolution. It made capital less physical. A fortune no longer had to travel in boxes drawn by horses or camels. It could travel as writing, reputation, and accounting. The banker became powerful because he stood between places, connecting everyone's capital. The Medici Bank showed how this worked. Florence was not an empire, yet its bankers could touch the finances of Europe. The papacy collected revenue across Christendom. That money had to be transferred, converted, and advanced. The Medicis offered that service. In return, they gained fees and influence. They were not rulers, but rulers needed them. This is where capitalism changed shape. Wealth was no longer only the result of production. It could come from managing payments and risks. The person who controlled the ledger could shape those who controlled the land. The same pattern appeared in Germany with the Fuggers. They began in trade and mining, but became most powerful as financiers. Their money helped the Habsburgs wage politics at continental scale. When Charles V sought election as Holy Roman Emperor, Fugger finance helped make it possible. That example reveals the deeper incentive. Rulers needed cash before taxes arrived. Wars did not wait for harvests. Elections did not wait for rents. Bankers could turn future income into present cash by issuing credit. The bankers took enormous risk. Rulers could default or change the rules. They could punish creditors. But the reward could be extraordinary. In exchange for loans, financiers could receive mining rights, tax farms, and monopolies. Credit became a bridge between private capital and public authority. This was a conversion of feudal power into financial form. Lands still mattered. Titles and armies still mattered. But they now depended more heavily on cash, and cash depended on credit networks. The transatlantic world pushed this system into a harsher form. Oceanic trade required more capital than a family merchant house could risk. A voyage could be ruined by weather or war. Ships took months to return. Losses could destroy a single investor. The answer was to pool capital. This is why the joint stock company became one of the most important inventions in the history of capitalism. It allowed many investors to buy pieces of a venture. The risk was shared. The enterprise could last beyond one voyage. Shares could be sold to someone else. Ownership became portable. That changed everything. Before the joint stock company, long-distance trade often depended on tight partnerships. After it, investment could be separated from management. A person in Amsterdam could own Asian trade without ever boarding a ship. A person in London could profit from conquest without seeing the coast. The Dutch East India Company carried this model to a new scale after 1602. It gathered private capital, received state backing, and built a commercial machine across oceans. It negotiated, fortified, and fought. The company made profit from trade, but also from power. The English East India Company followed a similar path. It began as a trading company under royal charter. Over time, it became a political force. In India, it collected revenue and commanded armies. The line between business and government blurred because the incentives pushed it that way. Investors wanted high returns. The state wanted influence. The company wanted a monopoly. The joint stock company solved one capitalist problem and created another. It solved the problem of scale. It created the problem of distance without responsibility. Owners could benefit from actions they did not personally perform. Managers could make decisions for investors who lived far away. Coercion and extraction could be converted into dividends. That is the key leap. Capital could now act across the world while wearing the face of a corporation. It did not require any single individual person. It had legal continuity and transferable ownership. It connected private gain with state power. The next transformation came through public debt. Britain became the decisive example. The Bank of England was founded in 1694 as a private bank serving the government. Its purpose was tied to war finance. Investors lent money. The state promised repayment through taxation. The bank helped turn national credit into military capacity. This made Britain unusually powerful. A ruler with poor credit could raise money only at great cost. A state with trusted institutions could borrow again and again. It could build fleets, subsidize allies, and survive long wars. Debt became a weapon because it moved future revenue into the present. By the 18th century, capital had developed a full toolkit. Banks moved payments. Joint stock companies pooled risk. States used debt to expand. Stock markets priced claims on future profit. Capitalism was no longer just commerce. It organized time, trust, and force. The Industrial Revolution gave this system new material power. Factories, railways, and steamships required heavy investment. They also promised returns that local savings often could not fund alone. British and French capital moved into foreign bonds, mines, and railways. Later, American finance joined the same world. The incentives were not mysterious. Investors wanted higher yields. Borrowers wanted infrastructure. Empires wanted raw materials and secure routes. Local elites wanted access to credit. Everyone desired growth and development. The global gold standard gave this world a common monetary frame. It promised convertibility and discipline. London became the great clearinghouse. Capital crossed borders with unusual confidence. To investors, this looked like order. To workers in colonies, it often meant adjustment under pressure. The system was powerful because it could coordinate distant activity. It was dangerous because it could transmit shocks. A banking panic in one place could affect borrowing in another. A fall in commodity prices could damage a colony. A change in interest rates could reshape a government's budget. Then came World War I. The war exposed the dependence of transnational capital on political order. In 1914, markets closed, gold movements were restricted, and governments took command of credit. The same financial machinery that had supported trade was redirected toward mass destruction. Debt exploded. Industry served the battlefield. After 1918, the old order was damaged beyond repair. Europe was burdened by debt and reparations. The United States had become a creditor power. Germany faced instability that moved from inflation to depression. Capital still crossed borders, but trust had been weakened. The Great Depression shattered what remained. Money fled failing banks. Trade collapsed. States raised barriers and abandoned old commitments. Capital mobility now looked like a threat. By the Second World War, governments again subordinated markets to survival. The history shows why transnational capital is not just a modern corporate story. It is the long result of capitalism learning to detach ownership from location. Feudal Europe tied wealth to land. Renaissance banking turned wealth into transferable claims. Joint stock companies turned distant risk into shares. Public debt turned future taxes into present power. Industrial finance turned global development into an investment field. Each step made capital more mobile. Each step widened the gap between those who could move and those who could not. That is the central impact. Capitalism changed from a system centered on possession into a system centered on command. The decisive question became less who owns this field and more who controls the claim, the credit, the contract, and the route. Modern transnational capital did not appear from nowhere. It inherited its logic from bankers who moved assets without motion, companies that ruled without crowns, and states that fought wars on borrowed futures. The concept is powerful because it changes what power means. Power no longer has to sit on a throne or own a manor. It can sit in a balance sheet. It can move through a share certificate. It can travel through debt. It has no face and no clear central point of failure. Once capital learned to move this way, capitalism stopped being local. It became a system that could reach across borders, reorganize states, and turn distance itself into a source of profit. The next video will talk about transnational capital in the digital age. Stay tuned.